Welcome to this explainer. Okay, today we're targeting something absolutely crucial, a highly valuable mechanism detailed in the IRAS, that's the Inland Revenue Authority of Singapore guidelines. Look, if you're a business owner here in Singapore and you're looking to expand overseas, you're going to want to stick around. This explainer is your ultimate guide to navigating double taxation. Let's explore this together because honestly, understanding this one single topic, it can drastically change your company's global growth potential. But hey, before we get lost in the numbers and the rules, we really need to look at this quick public service announcement right from the header of the source material. When we're dealing with sensitive corporate tax data, trust is literally everything. You should always look for that .gov.sg domain. That immediately tells you you're on a verified government agency website. And for sure, double check that you see the little lock icon or HTTPS in your browser so you know the connection is totally secure. I know it sounds super simple, but verifying you're on the official portal, that is step one in protecting your business and establishing credibility. Okay, let's dive into this. Here is our roadmap for the explainer. First, navigating official tax portals. Second, the corporate tax ecosystem. Third, the double taxation dilemma. Fourth, foreign tax credit. And fifth, double tax relief. Section 1. Navigating official tax portals. The scope of the Singaporean tax system. So when you first look at the sheer volume of information here, it's completely overwhelming. You've got individual income tax, corporate income tax, property tax, GST, stamp duty, international tax. I mean, wow. If you're a business owner just trying to figure out what rules apply to your newly earned overseas revenue, this massive, all-encompassing system can induce an instant headache. Honestly, it's perfectly normal to feel totally confused by this labyrinth. But don't worry, we're going to filter out that noise. Section 2. The corporate tax ecosystem. Finding our specific rule. Let's move to and see how this builds. To find the specific policies on foreign revenue, we kind of have to click through the bureaucratic maze. Step 1. We completely bypass individual taxes and zero right in on corporate income tax. Step 2. We drill down into income and deductions for companies. And then finally, step 3, we arrive exactly where we need to be. Companies receiving foreign income. That right there is our target destination, the exact little corner of the ecosystem we're analyzing today. Section 3. The double taxation dilemma. The penalty of expanding overseas. Now let's consider a really core question. What actually happens to foreign income when it enters Singapore? Think about it. You've expanded beyond our borders. You've successfully generated revenue in a totally foreign market, and now you want to bring those profits back home. So what happens to that money next? Well, without the proper mechanisms in place, it becomes a deeply frustrating problem. First, your hard-earned income gets taxed in the foreign jurisdiction where you earned it. Fair enough, right? But then, when you remit that exact same income into Singapore, bam! It gets hit with a second tax. Your revenue is literally slashed twice. Understanding this dilemma is exactly why this explainer matters so much. You just cannot afford to lose your hard-earned margins to double taxation. Section 4. Foreign tax credit. Alleviating the double taxation. Now, what's really interesting about this slide is the precise language the source uses here. A foreign tax credit represents the mechanisms that a Singapore company may enjoy to alleviate the double taxation suffered. Did you catch that? That word enjoy is key. The tax authority actually provides these tools specifically to give you financial relief. It's essentially a structural acknowledgement that taxing the exact same money twice really stifles economic growth. The FTC is the official solution to keep your business thriving. Section 5. Double tax relief. The avoidance of double taxation agreement. Look, I know bureaucratic acronyms can be incredibly dry, so let's break this one down. An avoidance of double taxation agreement, or DTA for short, is essentially an official legal treaty between Singapore and another specific country. It's a formalized agreement that expressly provides relief to reduce double taxation, and it typically does this in the form of a tax credit. Think of this as the international legal foundation, the absolute bedrock treaty that gives you the right to protect your revenue. So the crucial point is how this translates into actual practical relief for you. Double tax relief, or DTR, allows a Singapore tax resident to claim a credit for the foreign tax already paid against the Singapore tax payable on that exact same income. It's a direct mechanism to offset your costs. Basically, if you pay tax over there, you can use that as a credit against what you owe over here. The only catch is it has to be the very same pool of money being assessed. Let's make this highly actionable. Here's a simple 3-step checklist to detail the exact mechanics of how this works. Step 1. You've got to officially identify as a Singapore tax resident. Usually this just means the control and management of your business are exercised right here in Singapore. Step 2. You meticulously calculate the exact amount of tax you've already paid in the foreign jurisdiction. You got to keep the receipt, so to speak. And step 3. You claim that credit against your Singapore corporate tax on that exact same income when you file. By strictly following these steps, you take a super complex government policy and turn it into a simple checklist that protects your retained earnings. I really want to conclude by leaving you with this powerful little fragment of a quote directly from the IRS guidelines to alleviate the double taxation suffered. I mean, that is the ultimate stated goal of the foreign tax credit and the DTR. It's not some sneaky loophole. It is intended, purposefully designed relief meant to encourage your growth. So my question to you is this. Now that you clearly understand the mechanics of this tax relief, how is utilizing it going to completely change the mathematical models and the margins on your next big overseas expansion? Could this be the catalyst that finally makes your global strategy viable? Thanks so much for joining me for this explainer, and hey, keep exploring those growth opportunities.